Live and welcome to another Sunday Night Futures Live. I hope everybody had an awesome weekend. It's good to be back with you. I'm looking forward to the markets being open tomorrow. And it was a beautiful day here in New York. Horrible yesterday, tons of rain, but a beautiful day today. Spent some time with the dogs. Can't ask more than that. And the futures markets are open. And we're going to talk about um, let's just get it out of the way. I think that the markets are going up higher. It was posted in our Slack forum by one of our fellow members, Talon, that the uh, month of April is one of the best months of the year. That is true. I think it's the second best month of the year. We're going to go to it in a moment. But there are a couple of weeks in between now and then that are somewhat rough weeks. And we're going to talk about the advanced decline line in this market because the participation inside the market is not good. You can look at the chart and you can say, this is a chart that wants to go up higher. But when you dig down and you take a look at the underlying structure of the market, your new highs versus new lows, advanced decline line, your put call ratio, things like that, skew index. And you kind of you look at it and you go, Jesus Christ, we've come a long way in a very, very short amount of time, and with only very, very few participants in the market. I mean, the S&P 500 is up. I forget what it is on the year so far, but you have the IWM, the small caps, which are down on the year by about 11%, vastly underperforming. I think that's going to change, but we want to be careful in this market. We're going to talk tonight about the fact that, again, I want to get out of the way. I don't want to be doom and gloomer. I think the markets are probably going to go up higher, but what we're going to talk about is what we should be looking for to make us go looking towards the exit door and perhaps getting a little bit more defensive moving forward. So we're not there yet, but we have our eye on the exit door because this type of a market, I've traded through it in 2000, 2007, 2020, 2018, and it all feels the same. It's a game of musical chairs. You know it's got to end. You just don't know when it's going to end, and it always looks brightest before the dark. It's the exact opposite of it always looked darkest before the dawn. So it can go up a lot higher, okay? So we'll talk about valuation and so on. So let's go to comments. We'll say hello to folks, and we'll go to the futures action. In fact, I will share my screen now so that we have something to look at besides my mug. Okay, there we go. And we have Mr. Pete. Welcome. Larry, we're seeing panic selling in the grain markets. Corn may be the first to give us a buying opportunity. It's funny you say that. I was looking at those charts earlier, prepping for the show. I couldn't agree more. Hey, Denny, are we on for tomorrow night? Jeffrey, welcome. Okay, so let's get to it. The E-minis gapped up. I'm not sure why they're not showing me the after hours session. It's checked. Why is it not showing? There we go. That's why. Okay, that's better. Okay, so we are at current down relative to the close on Friday. Now, on Friday, you saw a pullback in the S&P 500, and we're trying to gap up at current. It looks as though bulls are probably going to win out here. The chart that you're looking at is one that we're going to be talking about quite a bit tonight. This is what you call a squeeze chart. In orange, you have the Bollinger Bands. In beige, top, whatever you want to call it, off-white, eggshell, you have the Keltner channels. And you can see that we're setting up for a squeeze here. There's no guarantee it's going to go in one direction or the other. But in general, it'll follow the path of least resistance, which is to the upside. So we're moving up higher relative to the after-hours session, but down relative to the close on Friday. Moving on to the Russell 2000, of which we have added to our, well, actually, it was on our watch list. It broke out last week. Now we're ready to add more to that position. Members, we're going to go over tonight the charts I like for the new trading week. I did not have an opportunity to do best stock charts for the new week. We're going to go over last week's picks. We'll talk about how they did, and we'll talk about this week's picks and the whys behind why I like them. In the members area, we have entry points, stop points, and price targets. So it's already updated and ready to go. All right, so the Russell 2000 is up, and it's looking pretty good here. So we're liking the Russell 2000 after its breakout last week. Moving on to the NQ, the NASDAQ 100, gapping up. We are up spot 7% or 13 points. Very, very tight. Bollinger Bands trading within the Keltner channels. It's a Bollinger Band squeeze. So they're already lighting up the screens. The question is, do we carry through to tomorrow night or tomorrow morning? The Dow Jones Industrial Average opening down just like the S&P 500. It traded lower in the after-hours session on Friday. Quite odd. Usually you don't see that. Usually it just stays flat over the weekend. And that did not happen. Moving on to, I want to take a look at the mid-caps. The mid-caps, we spoke about them about 3 weeks ago, and they have been on a tear. And again, they're gapping up. And they want to go up higher. You know, we're off the session highs, but again, you saw a Bollinger Band squeeze, and we are breaking out of that compression zone. So mid caps, small caps, my favorite area right now of this market, and they have been for the past couple of weeks. Now, moving on to currencies for a moment, the dollar is it traded up in the after hours session on Friday, but it is now moving lower. However, we have not broken down below the lows of Friday. Taking a look at the euro yen. Euro moving up higher. Actually flat on the session. Flat on the session. Bollinger Band squeeze forming. Yen. Oh. Bollinger Band squeeze. Yeah, the Bollinger's trading within the Keltner channels. This is probably going up higher. So that means trouble for the US dollar. A lot of trouble. But with that trouble, that means opportunity where? Just as we spoke about last week, and that was in the gold markets. And last week, we had a new intra-week all-time record high. I don't believe it was a record closing high, but a new intra-week all-time high on the price of gold. Nobody was paying attention to this rally. We added more the week before last. Nobody was paying attention to it. It was a stealth breakout, and we love that. Taking a look at silver. We're going to be talking quite a bit about silver tonight because I love this chart. Okay, it's down at current, and I'm glad because when you take a look at a weekly chart of silver, again, you have your Bollinger Bands trading within your Keltner channels. Now, there's no guarantee that the resolution to this compression zone is going to be to the upside. But if you get a drop in the US dollar, a rally in gold, a rally in tips, and a drop in yields, it's going up. So silver looking really, really good here. And of course, It has already broken out. It broke out the week of the 12th of February, retest 1, retest 2. We want to know when it breaks out. We already own it, but we want to add more. And I may even buy some call options, not put options. All right, so we're really liking the price of silver here. I hope they open it down. That way I can add more tomorrow morning. 4-hour view, a beautiful rip on Friday. This is the afternoon candlestick. Gorgeous, absolutely gorgeous. Just went flat on the session. Silver is going up. And just to go back to gold for a moment, let's take a look at how the week looks. Here's the weekly chart. Here was your compression zone back here. And then nobody was paying attention to this. Higher highs, higher lows. Beautiful. It's going up. Let's go back to the intra-week chart. I want to talk about energy. Now, a word of warning on gold. I want to bring up the daily chart for a moment. For those that are thinking, you're listening to me right now, you want to go buy gold right here, right now, I would caution against that. While it may move up higher, I have little doubt it's probably going to move up higher tomorrow. Look at where we closed out the trading day. Closing above this is a 2 standard deviation Bollinger Band. So we're already tapping the 3rd standard deviation Bollinger Band. I wouldn't suggest that anybody go opening a new position or adding to a position when you're trading up and into a 3rd standard deviation Bollinger Band. That would be a little bit irresponsible. You may want to wait for a pullback, maybe sell puts, reduce your basis cost when the shares get assigned to you. There's no guarantee they're going to get a pullback, but we could quite very well get one. Now, moving on to beautiful setup here. Look at this squeeze setting up. I predict that before we log off tonight, gold will have gone positive. Okay. Now, moving on to energy. Light sweet crude. I want to take a look at the weekly chart first to get a vibe for what type of consolidation has been going on there. And it's putting in higher lows. We have broken out. So the reason why this matters, and we'll talk more about this in a moment, the reason why this matters is because you have a lot of talk out there that we're going to get a rate cut. I'm starting to think more and more that absent a geopolitical event, absent some sort of economic catastrophe here, I don't think we're getting a rate cut. Not with inflation the way it is. So, if you think about it, they're coming out and they're telling us that we have a 3.2% GDP, gross domestic product. The reason why we have that gross domestic product is because of government spending. The government spending is fueling inflation. So they're going to cut rates so the government could borrow more to goose up GDP. Doesn't make sense. So I really wonder as to whether or not we are going to get a rate cut this year, absent a geopolitical event. But the fact that we have a Fed that is clear that they will not be raising rates anytime soon. The markets have been happy with that. They're good with that. The problem is the day that they're not happy with it anymore. They're going to demand rate cuts at some point in time. But right now, it's all Goldilocks. The problem for the markets is that as we see oil prices move up higher, as we see agriculture, it looks as though, I'm going to go to it in a moment, it looks as though we bottomed out last week with some reversal bars. As you get these prices creeping up over the next couple of months, what are these CPI reports, PPI reports, PCE reports, all these inflation reports, what are they going to indicate? They're going to indicate that we have inflation back in spades. So beware here about the fact that you have oil, which goes into everything. Any manufactured product has some component of a petroleum product in it, tires, etc. So forget about that backing out food and energy out of the inflation number. It's still in the non-core, in the core number. What do you want to talk about now? Nat gas. Oh, does anybody notice, by the way, that gasoline prices have only gone up? This is the RBOB weekly chart. Look at this Bollinger Band squeeze here. Look at this move up higher. I mean, my God, what kind of a move was that? Here's gasoline versus the S&P 500. You think that the S&P 500's hot? It's got nothing on gasoline prices. Here you have it. Ratio chart, gasoline versus SPY last week. It outperformed the S&P 500 by over 3%. How long do you think that's going to last for? And as a standalone commodity, we were up over 4% on gasoline. Do I want to own gasoline or the S&P 500? Give me gasoline. Now, looking at nat gas, we booked profits last week on nat gas on that squeeze up higher. NQ and NG. And Q is the NASDAQ 100. And here you have it. Again, we are up. This is the NASDAQ 100. I got the wrong one. NG. There we go. We are up 3.3%, nearly 3.4%. So we have natural gas prices that appear to have bottomed out now. Gasoline prices, which are breaking out. Oil prices breaking out. Taking a look at agriculture, corn. Look at the price action last week. They have decimated corn. And now last week, it appears as though we may have a bottom here on corn. It looks as though we're probably going to go higher. As for soybeans, same deal here. Hammered, bullish reversal bar last week. I don't think that wheat had a good week last week. It did not. In fact, it's still looking fairly weak here. So I want to take a look at the DBA. This is the agriculture ETF. And that has been doing fairly well. Down last week, but we're very close to breaking out of this cup handle formation weekly time frame. So we're seeing inflation. We don't need to wait for a CPI report to come out or a PCE report. We do this every Sunday night. So it's clear. And the gold and silver markets are now validating the fact that we have inflation and we have a Federal Reserve that plans on doing nothing about it, with the exception of sitting on their hands during this presidential election cycle. We say hello to folks. Dane, welcome. Hi, Bob, and group of people. Welcome, Mike. Mark, welcome. Yes, please hit the like button. Thank you. I always forget to do that. Mr. Pat, yo, Bob, here in Tennessee on the phone. Good for you. Good for you. You with your grandkids? Awesome. Central Time. Nice. Very nice. Okay, let's go to economic data coming out this week. So we have this can't be right. Tomorrow's the 4th. There we go. That's right. All right. So a light day tomorrow. Now I posted in the Slack forum. I did a lot of analysis. We've been doing some zero DTE trades of late. And I spent a lot of time this weekend. That's the reason why I couldn't get to best stock charts. And we'll go to them in a moment. I did a lot of analysis on back testing of zero DTE strategies and the outliers, the days where they lost money. I actually took those dates and I popped them into Chat GPT and I sorted by date, day of the week, and economic data that was reported that could have affected that day where you saw losses in zero DTE trades using iron condors as an options trade. So we're going to try to use that data. I pinned it in the members area so that way you could go to it. If you're thinking about putting on a trade, be careful of the economic reports. Wednesdays and Fridays in particular, very dangerous days because those are Fed days where you get the Fed release. You also get on Fridays non-farm payrolls, and you get GDP reports as well. So beware, in particular, Fridays and Wednesdays. Mondays is actually the safest bet to do zero DTE trades. So tomorrow, no economic data. We have a Fed head out there giving his opinion. Tuesday, factory orders. They're expecting a negative read. If it comes out positive, beware. I doubt it will, though. ISM Services Index. Any read above 50 is a sign of expansion. More Fed heads coming out this week. On Wednesday, we get ADP report. I would not be, at least not early in the morning, I would not be doing any zero DTE trades because you have not only ADP at 8:15, you get at 10 a.m. Jay Powell in front of Congress, and that's usually a 2-day affair. So yeah, that's on Thursday as well. I think he goes in the House first, and then he goes to the Senate second. So be careful of very, very short-term trades during those 2 days. That could really move this market one direction or the next. At 2 p.m. on Wednesday, Fed Beige Book. Again, this really all makes sense as we're looking at the economic data relative to the statistics that we ran, that Wednesdays and Fridays are a real trouble spot. U.S. productivity coming out on Thursday, and this is jobless claims. We get that every week. And on Friday, the pimp Mac Daddy of them all, non-farm payrolls. Watch for wages. Watch for wages. They've been coming out hot of late. They were hot on the CPI report last. Now, expectations of a rate cut. We're going to be watching this little box here. Probability of an ease in March, nada. Not going to happen. For May, this actually popped up. This was lower. June, this popped up as well. Now we're at 74%. This was at 61, 62% the other day. July, this is about the same as what it was the other day. I'll check back in tomorrow morning because on Friday afternoon, actually yesterday morning, this looked a lot different. Valuations of the market. $34.5 PE multiple, rearview mirror, meaning trailing PE multiple on the S&P 500 relative to the mean at 17. So we are very, very frothy here in terms of valuation. Now you may be saying, earnings were so great. What about forward-looking expectations of PE multiple? Okay, not that great either. All right, the forward 12-month PE ratio for the S&P 500 is 20.4, above the 5-year average of 19 and above the 10-year average of 17.7. All right, so both on a forward-looking basis, on a trailing basis, the equity markets or the S&P 500 is very expensive. Earnings coming out this week. A lot of mid-cap players here, but there are some large-cap guys coming out. You're going to have on Mondays, you usually don't get much. Before the market on Tuesday, a lot of retailers coming out this week. Target, CrowdStrike after hours, Ross Stores, another retailer, Nordstrom, another retailer, Box, JD.com, Chinese stock, Abercrombie & Fitch. That stock has been in fuego. More retail coming out. Foot Locker. These are not market movers. More retail. Victoria's Secret. Kroger. Big Lots. Burlington. BJ's. Costco after hours on Thursday. Broadcom reports after hours on Thursday. Petrobras. Gap. So this is a retail week. And it looks as though the semiconductor names and the tech names are just wrapping up earnings season. Now, I want to get into this because we're always looking at the what do you call it? Doing a pulse check of the sentiment of the economy. And I love this chart. I find it fascinating. And basically what this is, in blue, you have GDP. 50% of GDP is in blue, but another 50% is in orange, and they're all in the metropolitan areas. You have New York City, Boston, LA, San Francisco, Portland, Houston, Miami, and Atlanta. You have all of these areas where you have a lot of finance, a lot of services that are being done. And ever since that we stopped being that manufacturing economy, these power centers of the city have gained more and more power. So I find this really fascinating that in this very, very small microcosm, bubbles in orange, that's 50% of GDP. And the manufacturing space has been whittled down so much, it's now only 50% of our GDP. Scary stuff. But things are starting to change here a little bit. Several months ago, I did a video on the reshoring of manufacturing, or the reindustrialization of the United States. And this chart here I find fascinating. And it's manufacturing construction spending in the U.S. continues to hit new record highs, increasing 130% over the past 2 years. This is astounding. Now, while I'm very happy to see this, and I wouldn't change it for all the world. I think it's the greatest thing since sliced bread. The problem is that it's inflationary. All the input costs, copper, et cetera, all the input costs are going to drive up, unfortunately, prices paid at wherever you're going, energy prices, industrial metal prices. So until wages catch up, and those manufacturing jobs are good paying jobs, it's going to be a problem. At some point in time in the future, hopefully I'll live to see it, you'll see equilibrium yet again. But right now, it doesn't look like we're going to get there in the next couple of years. But this is a great, great chart. It should make everybody feel a little bit more optimistic about the future of this country. Now, what doesn't make you feel all that comfortable is the pox that haunts us within this country right here, right now. And we all know about Fannie Willis. And the reason why I'm talking about this has nothing to do with equities. It has nothing to do with the financial markets until it does. There is a rot in this society. a political rot that, and they know it. They know they hate us for seeing it now. They used to hide it. Now they don't hide it anymore because they have a disdain for you and me. There's a disdain. And you can see what they're doing to a former president, whether you like him or dislike him. I wouldn't want to see it done to Biden if he was an innocent man. I don't want to see him persecuted by my own party. I don't want to see that. That's not American. That's Banana Republic stuff. But we saw what's going on with Fannie Willis out of Atlanta. She hasn't been tried and convicted yet, but it doesn't look good. And this one here, this is the Lolita James, who is prosecuting Trump in New York. And she is just spending up a storm, living the dream of a billionaire out there with donations to her campaign. But the donations are coming from what they call, I'll share this out because I don't have time to go through it all, ghost donors. They don't know who these donors are. So who's paying this woman to pursue these allegations and these charges against the former president? I'm no judge, I'm no jury, but I can have an instinct and an opinion, and in my gut, I'll share that out. It's very, very interesting reading. It doesn't look good. So the rot continues, and I think it has to, because the general election right now, Trump is way ahead of Biden. And to put this into context, you may be saying he's only ahead by, at max, 6 points on 2 of the polls. And even Biden's ahead on one of the polls by 4 points. One thing you need to remember is that there was no poll out there in 2016 prior to the election that had Trump winning against Hillary. There's no poll out there in 2020 that had Trump winning. And you may be saying he lost the election. Yeah, right. Yeah, look at the data that's come out ever since. I don't believe that for 1 second that this guy beat Donald Trump. But the fact that they're admitting this now is shocking. So this leads me to believe that he's beating Biden by a hell of a lot more than what these polls are insinuating. So what does that mean? It means that they need, the deep state, the globalists need a problem out there that draws the attention of the American voter away from the power elite in DC and overseas. This is what governments have done for millennia. If you have problems at home, you go to war, stoke nationalism. And this came out over the weekend that you have German generals, and this is not me saying this, the German government is admitting that this is accurate data. The Russians were able to intercept communications between German generals talking about bombing a land bridge in the Crimea, which is currently Russian territory. That is an act of war. They are currently, I don't know if this is true, but there are suspicions that we have NATO troops on the ground dressed up as Ukrainians already in Ukraine. This will not end well at all. We all would be lucky to live through it if this is at all fact. So when we talk about threats to this market come out of the blue at times. COVID, who saw that coming? It took a while for the markets to react to it, but inevitably they reacted, and they reacted very, very harshly. The financial crisis, everybody should have seen, but they didn't. The dot-com crisis, it was just like now. Very, very expensive equity markets. The difference between now and then is that the Federal Reserve was raising rates. They're not raising rates at current, but inflation is on the rise. So while we talk about this market continuing, and I do believe it's going to continue up higher, I've been talking about sector rotation happening. We are seeing sector rotation. Be very, very careful, because I keep saying that this is a game of musical chairs. And what's the key to musical chairs? You never know when the music is going to stop. And you're going to be lucky if you can find a seat. The problem is that there are too many asses that don't have a seat out there, and a lot of people are going down. So that's why what we do is we'll remain bullish on the equity markets, but we're going to look underneath And we're going to take a look at the structure of the equity markets to see what's out there. Are we seeing signs of trouble that the overall market is overlooking? And that's what we're going to talk about now. We have the rot in Washington. We have the rot over in the World Economic Forum, over in NATO. They can cause a tripwire event at any given time because they're driven by incompetence. So we have this type of leadership. We don't need enemies. So fast forward, our so-called esteemed, venerable, honorable representatives continue. The national debt is growing by $1 trillion about every 100 days now. $1 trillion deficit was an anomaly going back 5 years ago. It was an anomaly. Now it's every 100 days. We still are in an emergency spending environment in Washington, D.C., and the emergency spending began with COVID. And the CDC just came out and said COVID should be treated as the flu for people 65 and older. But we're still doing emergency spending. But that emergency spending is not for our emergency. It's for the people overseas. They're taxing us and they're offshoring it. They're taxing us and they're giving it to illegals. This is a recipe for utter disaster. It's only a matter of when. It's unsustainable. It's unsustainable. I'm not that smart enough to say when it's going to end. I think that I'll know what it looks like when it does end. What it's going to look like is both the U.S. dollar and the U.S. Treasury bonds, bills, dropping like a rock together. When that happens, things are going to get real fast in this economy. Nobody's going to want to be underneath that. That's Argentina. That's Venezuela. That is Rwanda. I mean, that's bad stuff. And it's all predictable. And here is the interest payment on our debt. Interest payments on the U.S. government's debt have surpassed a $1 trillion annual rate, increasing 98% over the past 3 years. That is now greater than our national debt. Pardon me. That is now greater than our defense budget. Sorry, brain fart there. So, again, folks, this is unsustainable. You want to know why the Federal Reserve can't raise rates? This is why they can't raise rates. This is why. This is why you have Elizabeth Warren out there saying you got to cut rates. But what she doesn't understand is that if they cut rates, let loose the dogs of inflation. That's why I believe that they're going to be cutting rates anytime soon. And that runs against the Fed Watch tool, which actually improved in the past 24 hours. Now, come on, X, what are you doing here? Consumer confidence. So we have inflation on the rise, debt on the rise, and what's happening? Consumer confidence is at nightmarish proportions. This is from last week. This marked the biggest when we saw from the beginning. What is happening to consumer confidence data? Consumer confidence fell to 106.7 in February, missing expectations of 115. That's a huge miss. Meanwhile, January consumer confidence was revised significantly lower. This marked the biggest downward revision since February of 2022. Meanwhile, we have seen 4 straight months of sharp drops in consumer confidence. Why are consumers losing confidence? They're not making the money. Prices are going up. Even though produce costs are going down, they're still going up in the restaurants, they're still going up in the supermarkets, and the consumers are feeling it. This is from the Federal Reserve. The Fed's recession gauge skyrocketed to levels a few months back, record levels a few months back. This points to a high chance that we are heading into recession in 2024. Now, to me, This is why, if anything, we are seeing expectations for a rate cut increase. And do I have I don't think I have it up here. And the other thing that we want to take a look at is that whenever you see recession as a threat, you're going to see the 10-year yield begin to roll over, even if there's no expectations for a rate cut, because the bond market is telling you, hey, listen, yeah, you got a problem out there. This is the bond market saying, hey, this tweet here, they're not wrong. They're not inaccurate. We are unwell. And with economic data as measured by consumer confidence rolling over the way it is, how do you expect to keep a 2% GDP growth? The only way you get to do it is if the government keeps spending. The minute they stop spending, that's it. That's it for this market. Jesus Christ, hurry up. Okay, so here's kind of where the rubber meets the road. The current narrow rally in stock concentration is at levels last observed just before the 1929 Great Depression. I know this is hard to see. Let me see if I can zoom. Yeah, there you go. So in dark blue, the line chart, you have market capitalization concentration among the 10% largest U.S. equities. So what is that? NVIDIA, Amazon's coming back now, Microsoft, a handful of stocks. It's certainly not Tesla. It's certainly not Google anymore. They're done. That's dead money. You only have a few stocks carrying this market up higher. And here's a chart. Here you have the NASDAQ advanced decline line. And you can see that we are putting in lower highs on advancers versus decliners. But all the while, here's the NASDAQ composite in line chart, completely ignoring it. It blew through the upper band of this uptrend channel back in January. This, to me, it has the eerie resemblance of a blow-off top in the NASDAQ. The thing is that it can continue. I'm not saying that tomorrow this is going to be a NASDAQ bubble. I didn't know in March of 2001 that day when I was walking down the streets of Times Square, peeking in, getting a quote for my short put position on PMC Sierra, that was exactly the top in the market. So you never know. You just don't know the day it's going to hit, but one day it hits and it ain't pretty. So beware. You have too few stocks driving this market up higher. And what's the multiple on NVIDIA now? $68.93. I thought it would be higher, to be honest with you. NVIDIA RSI 87 now. What's it on? That's on a weekly chart. Oh my God. And for those out there, what is it? SMCI. They got added to the S&P 500 after hours on Friday. Before you go chasing this stock tomorrow morning, I'm going to warn everybody. You have RSI on a weekly chart on Supermicro at nearly 92. So I've heard about this addition to the S&P 500 for the past 3 weeks. It's not a secret that it was going to be added to the S&P 500, yet they boosted it up 16% after hours. And they did it on about less than 600,000 shares. So beware about chasing the stock up higher tomorrow morning. I want to go back and take a look at a daily chart of NVIDIA. Incredible. Up another 4% on Friday. Absolutely incredible. Let's take our crayon out and play a game. Yeah, we can still go higher. I'm putting a price target here, short term anyway, at around 850, 860 on NVIDIA. Okay, moving on. Put call ratio. I'm not going to spend much time here. I want to get to our charts for the new trading week. I want to point this out that we have put call ratio very, very low. Puts are so cheap right now, it's ridiculous. I sell puts and I can't get a good premium for them. I get more premium on calls now. That's not supposed to happen. You're supposed to get paid more for your puts historically than you do for your calls. That's not the way it is right now, especially on super micro. So whenever you get this, and I'm not saying that we are at ridiculously low levels that this market can't continue up higher. It can. I think it will head up higher. Why is this not giving me a crosshair? Talon, hey brother. So here we are at the lower end of the spectrum. Now, usually when you get down here, like back here, you get a correction. But we've tapped it, blip on the screen, ignored, ripped up higher, but we're consolidating down here. At some point in time, this energy is going to get released. A lot of people out there are building bearish positions, buying cheap options. So I took advantage of the SPY being cheap and I bought some options. They broke out on me. I'm going to close them out tomorrow probably. But these options are cheap and people are probably building, and I'm not talking about people, I'm talking about whales, building an insurance policy, and they're being smart. They understand that this is unsustainable. At some time, we're going to come back and we're going to correction. Are we going to crash? I don't know, but at least 5-10% correction. Because you got to think that here we are on the year so far. NVIDIA, back to NVIDIA, my whipping child for the year, or the night anyway. Here's NVIDIA within the first 3 months of the year, up 66%. That's mind-boggling. SMCI, 218%. SPY, up 8%. Just goes to show you how too few stocks are dragging the markets up higher. QQQ, I bet you they're not doing all that hot relative to the S&P 500. They're just marginally outshining the S&P 500, which would have been unheard of this time last year. So it just goes to show you how the Qs are beginning to break down now. This time last year, you had Tesla, you had Google leading the charge up high, along with the other stocks, a broad-based rally in the NASDAQ 100, vastly outperforming the S&P 500. Now those names are just dropping off one by one. US dollar, this actually looks kind of bullish to me, so I'm not calling the dollar out yet. I don't even know why I brought that chart up. I want to talk about this one for a moment, and that is a ratio chart. What happened to it? A ratio chart of the S&P 500 versus the yield curve. For those of you that haven't been tracking the yield curve. I do it every single day, probably 3 times a day. And you wouldn't know it by the performance of the equity market last week, but the yield curve began to steepen again. And it closed higher on the week. Again, you wouldn't know it by the performance of the equity markets. But what I wanted to do is I drew this chart quite a while ago. And it's driving me crazy. I can't find my annotated version here. Anyway, you could see that for the longest time, again, yield curve versus the SPX, weekly chart. We were in a downtrend, allowing for the S&P 500 to boom. That all ended here a year ago. It'll be a year ago on Wednesday that we bottomed out on the yield curve, rallied, pulled back, and now what are we doing here? Instead of putting in lower highs, lower lows, right? That's all come to an end. Now, what you're doing is that you are now putting in higher highs. Now, what happens when the yield curve breaks out relative to the S&P 500? S&P 500 overlaid here in black rolls the F over because that's the yield curve steepening. That's what the markets do not want. And that's what nobody on CNBC is going to be talking about tomorrow morning. They're going to be talking about SMCI being added to the S&P 500, rah, 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 go by the stock. They're not going to talk about the 92 RSI reading on a weekly chart of the stock. They won't talk about it. And this is the last thing that they want you looking at. Last week, on a relative basis, you had the yield curve outperform the S&P 500, and it is on the verge of a breakout, a move up higher. Does the S&P 500 shrug it off? Maybe. It shrugged it off last week, but at some point in time, it will stop ignoring it. Mark my words. Okay, let's go over our charts for the new trading week. In fact, I'm going to go over the charts that I did for the week before, our best stock charts. And if you're not getting that to your email box, sign up for any one of our email lists below. I send it out to everybody. So I spoke about Amazon about 2 or 3 weeks ago. It's been on our watch list. Last week, it finally did what we wanted it to do, and that was a breakout. And by the way, members, go to the members area. I posted the link in the Slack forum. I updated all the price targets, entry points, and exit points, stop loss points on all of these names that are up here. So we broke out last week, and we're going to be looking to get long of Amazon. Amazon's looking really, really good. And the good part about it is that a good thing and a bad thing. Good thing is that this all-time high has a bullseye on it. The bad thing is that you have buyers up here that are going to want to look to get made whole. So you have some overhead supply, which is what you don't have on the S&P 500 at current. So that's the reason why Amazon has not been breaking out and trading as strong as the rest of the market, except for the past 2 weeks. The past 2 weeks, very, very good price action. So we finally got our breakout, liking Amazon. Another stock, what was that up last week? That was up 1.85%. Another stock from last week's best stock charts was Tidewater. Now, the reason why I didn't get involved with the stock, even though it broke out that week, was because, and this was up 9.83% on the week last week, and on the day on Friday, it was up about 14.33%. The reason why I didn't trade it was that they had earnings coming out. I couldn't buy the stock into earnings. Just don't do that. It did pull back on earnings. They beat on revenues, missed big on EPS, and it looked as though the shares were going to trade even lower. I was watching it, but on Friday they just ripped out of the gate. Never got an opportunity. So I have a price target here that I'm looking to get in at, but we're going to show some patience. Maybe I'll sell some puts. Domino's Pizza was another one. They reported they ripped up higher. They were up 3.13%, up measurably higher before that. They had an even higher gain on the week, but they gave a lot of it up. Airbnb, we were long of. We booked profits. It ultimately broke out above the upper band of resistance. I think this goes higher, but I also think we get a pullback first. Same deal with Amazon and Tidewater. The last one we had for, actually, no, the other one was TNA from last week. But that's still on our watch, so we're going to talk about that. FCNCA. This is First Citizens Bank shares. Now, it's a $1,500 stock, and it's not optionable. Let me confirm that. No, there's no option. So I'm not going to trade this. I just talk about it just for those folks that are interested. This is one of our best stock charts. That was up 2.26% on the week. And the other one that was on our watch list from last week was TNA. Now, this was up on the week 8.82%. This is a leveraged ETF product. We're going to be looking to add more to our current position this coming week. And this is one that has already showed, and I think I went over this earlier. Perhaps I didn't. This is already on a weekly time frame back here. Went into a squeeze formation, and then it just started ripping out higher. Bull flag setup. We broke out, pullback retest last week, a follow through. Very bullish on the small caps. I think you're going to see the larger cap names losing momentum. Money's going to roll into these small caps. I mentioned this with the mid caps. They've already run a couple of weeks ago. MDY. The other chart I like going into the new trading week is Microsoft. Microsoft is another one that you have a squeeze on. You can see it here. Bollinger Bands, daily chart, trading with inside the Keltner channels. Bollinger Bands in black, Keltner channels in gray. We broke out on price. I'm probably going to have to buy Microsoft because I have a iron condor on Microsoft. I need to protect that call side position. So we'll look to profit on Microsoft to the upside. Maybe I'll sell additional puts as well. So we're bullish on Microsoft. Another one, IBM. Another squeeze, Bollinger Bands, trading within the Keltner channels. It broke out on Friday. I think this goes up higher. Again, all these members posted in the members area, entry points, stop loss points, price targets. PXD, Pioneer Natural Resources. You saw the resource plays. You saw commodity plays come back last week. What did PXD do? It broke out. And it was in a squeeze. It remains in a squeeze. I think this is going up a lot higher. Last one, weekly chart, Hess Corp. We have the Bollinger Band squeeze setting up here. Bollinger's trading inside the Keltner channels, consolidating nicely. Oil moving up higher. Energy stocks beginning to move up higher. Hess, our favorite trade going into the new trading week in the energy patch. Would have been Tidewater, but that has already left us stable. We need for that to pull back in. So let's do a chart request for Talon. And I just noticed we don't have Jody on tonight. So let's go over seasonality for a moment. This is the S&P 500 going back 31 years, or SPY going back 31 years. Monthly chart. March, a very strong month. April, it's a tie for first place with November. So seasonality for the next couple of months, very, very strong. But there is a but out there, and I want to bring it up. And it's not that it's horrible. Just take note. This is the week that we're going into. The next couple of weeks thereafter, subpar performance by the S&P 500. So just beware of the seasonality. We're heading into a seasonally strong April, May, but the next couple of weeks it may be a little bit iffy out there, especially considering how far we've come in the markets. Okay, so we have for Talon. Which one did you want, Talon? I'll go over Jeff's. Talon, remind me which one you wanted again. I wrote it down. I don't know what the heck I do with it. Gold, Barrick Gold. Love it. I already went over this the other day. Love it. I love the gold mining stocks. In fact, here is HUI. It's a basket of gold stocks relative to the price of gold. They are such laggards. Historically, the biggest gap between gold stocks and gold in history right now. So one of my favorite plays out there, and we sold puts on NUGT the week before last. We're up on that now. Loving the gold stocks. Loving them. So Barrick, best of breed player. Broke out last week. I'm a buyer here. You may get a pullback and a retest. Expect backing and filling. I mean, they're coming out of a very, very troubled sell-off here. Here's your higher low, and we broke out. Here's VWAP. Oh, that's actually the Keltner channel. That's a 20-period moving average for the Keltner channel. We closed above it last week. This is VWAP down here in blue. I'm bullish. I love the volume. Gold looking very, very good. Gold meaning Barrick Gold. Let's check in with gold prices. Did they go positive? No, still down slightly. CrowdStrike. Doesn't CrowdStrike report this week? I think that they do. Yes, Tuesday after the bell. So be forewarned. I know it's gotten beat up. It bounced back a little bit. I think it's sold off with Palo Alto Networks. I would not be a buyer in advance of the earnings report, nor would I short it. We recaptured a support level last week, or did we? I think that I just drew that line sloppily, and I never do that. No, we failed. We failed to break out last week. I would not be a buyer in advance of earnings. The risk reward is just not there unless you're going to throw a collar on it, meaning you're going to buy the stock, sell a call, buy a put to protect yourself. I would not do that at current. What else do we want to talk about? Oh, SCDG. Thank you, Talon. DG. I mean, so the technicals aren't good. But what is good is that you have a clear and defined stop loss point. If it breaks and closes down below, 64.50 per share, you got to stop out because that's a major break. However, is the upside is that you have a higher low. Now you're in waiting mode. Do we break out? Do we break down? You're going to get a lot of vacillation. It's a laggard. I would probably be a premium seller here, selling puts. Would I buy it here? Only if I'm going to sell covered calls against it and use a stop loss right below, again, a 60, 64.50 per share thereabouts. I don't want to see a new weekly closing lower low on SEDG. So that's my take on it. Dane, you're very welcome. TZ, you're welcome. Everybody, yeah, you too, pal. Everybody have a profitable trading week. Thanks for being here and have an awesome remainder of your Sunday. I'll talk to you soon. Be well.